This is the last video in my series of short videos for your Accounting for Organisations module, and I just wanted to recap on a few critical accounting conventions that we've come across over the course of this module. And I've listed them out here on my whiteboard. There's the accruals convention, which is also linked to the idea of matching, the money measurement convention, and also a concept called materiality. And we've come across these key accounting concepts or conventions over the course of the module. And I did say that in the multiple choice section of the exam, I would be examining you on some of these key concepts. So this is just a quick recap of some of these key accounting conventions. Now, the first one I want to start with is the accruals convention. And the accruals convention tells us that profit is the excess of revenue over expenses, not the excess of cash received over cash paid. So profit equals revenue minus expenses, not cash received. Not cash received minus cash paid. So when we prepare our income statement and our balance sheet, we prepare them on an accruals basis. So this links to the idea of matching. And what we're trying to match is the expenses that we incur in generating income in the same time period, in the same accounting period or accounting year. So that's what the matching concept is about. It's about gathering up all the expenses that you incurred in generating income in the same accounting period. And that's really important because you don't want to be having all your income in one accounting period or accounting year and then pushing all the expenses into a later accounting period, because then you won't be really showing properly what your level of profit is. So matching means you have to match the revenue with all the costs and expenses incurred in generating that revenue in the same accounting period. So revenue must be matched with the expenses in the same accounting period. Okay. Now, the next concept which is critical to us in accounting is about money measurement. And we consider this accounting convention particularly when we're thinking about assets that we might or might not include in our balance sheet. Now, you'll remember that the balance sheet is a statement of financial position at a point in time, usually at the company's accounting year or financial year end date. And the money measurement convention is particularly important when it comes to looking at assets, asset values that we show in the balance sheet. Because we only show as an asset in our balance sheet items which we can reliably measure in money terms. Now, what that means is that there's going to be some assets that a business might have which can't be reliably measured in money terms, and therefore those assets won't be included in the balance sheet. So we're going to only include assets in the balance sheet if they can be reliably measured in money terms. Now that's okay because we can measure assets like the value of inventory and the value of land and buildings and machinery, we can put values on those. Typically what we're looking at is measuring those at historic cost, what it cost us to buy them. But there are assets which we find it really difficult to put a monetary value on. And those assets are often human resource related, such as loyal employees and customers and suppliers. We can't put a value on those, so we simply don't show them as an asset in our balance sheet. It's not only human resources that are difficult to measure in money terms, but also the company's reputation. Now, a company with a good reputation, you can say that reputation adds value to the business, but as accountants, we can't put a monetary value on that reputation, and therefore we won't show that as an asset in our balance sheet. So the money measurement convention relates to assets, they're only recorded in the balance sheet if they can be reliably measured in pound note terms. So I'll leave you to have a think about other examples of things which might be assets, but which fail the money measurement test, and therefore we don't show them as assets. Now, the last concept I want to talk about is the idea of materiality. And materiality really means significance. In our accounts, we want to include assets and liabilities and costs and expenses where they are significant. And we have an idea in accounting that our financial accounts should show a true and fair view. Now, a true and fair view doesn't mean that the accounts are 100% right to the penny, but they shouldn't be materially or significantly wrong. And the test of materiality is whether the omission or misstatement of a value in the financial accounts might cause a user of those accounts to change the decision they may want to make. So if leaving out a value or getting a value wrong might lead to an investor, a user of accounts, making a different decision about investment in the company, then that value is material. It would possibly change the decision of a user. So when we're talking about materiality, we're talking about significance. We're not suggesting that every last penny has to be accounted for, only that accounts are not significantly or materially incorrect. So we can put a note here that materiality is about if omission or misstatement of an amount might cause a user of those accounts to change a decision. Because users of accounts, our stakeholders, expect to be able to rely on financial accounting information to make decisions. And therefore they expect that those accounts will not be materially or significantly incorrect. So that's just a sort of recap of some of the key accounting conventions that we've come across over the 12 weeks of this module. Those of you that go on to do accounting with me in Year 2, you'll be looking at these conventions in more detail. Those of you who are not going to come and do accounting in Year 2, well, you should be familiar with these critical conventions, and I will be assessing them in the multiple choice questions in the exam. Thanks very much for watching.